Hello. Today we're going to round up on investment appraisal. The topic I want to look at today is a lease or buy decision. If you remember those concepts that I said we're going to speak about on net present value, this is the last part, and I have a reason of putting this one as the last section because it is not actually an investment appraiser technique. So it's not like we're trying to decide whether to do an investment or not based on net present value. However, this is an application of net present value and actually a financing decision. I don't know, you might be looking at literature or your textbooks or whatever materials you're using to study, and you keep saying lease or buy on that investment appraiser topic. It's put there because it's an application of net present value, but not exactly an investment appraiser technique. So you are using an investment appraiser technique, which is NPV, excuse me, to make this decision. So it's an application of NPV, but on its own, this is not an investment appraiser. Because before you decide on financing something, you have already decided to do the investment. So investment appraisal is done. The question is now, how do I finance the investment? Excuse me. So you are asking, should I lease the asset or should I buy the asset? And that is what we want to learn today. How do you decide whether you want to lease or whether you want to buy? You always have to go for the cheaper option. So, which means you're going to calculate NPV. So you calculate NPV. And you go for the better NPV. Let me put it like that. Better NPV. So if your NPV is both negative, you go for the lower negative. If NPV is both positive, you go for the higher positive. So it's all about going for the better NPV, which is the higher NPV. That's what our better NPV is all about. So that's what we're going to be looking at today. And also, I need to also let you know that when we're talking of lease or buy, the type of lease that we're talking about is an operating lease. I've seen different literatures calling it a finance lease. And if you're a financial reporting student, or if you're very strong in financial reporting, you will know that there's a difference between financing lease and operating lease. So some textbooks call it financing lease. If they call it finance lease, it's not the type of finance lease that you know in financial reporting. For you to understand it consistently with your knowledge in financial reporting, please, it is an operating lease. Because financing lease, in the sense of financial reporting, is almost similar to buying an asset. So whatever is applicable to buy is applicable to financing lease. So this is not what we're looking at here. What we're actually talking about in this topic is a type of operating lease. So don't let textbooks confuse you with the word. The subject, the substance of that lease is an operating type of lease. And how are these different? Let me just compare operating lease quickly and buying decision. So I'll just call it a lease and I'll call it a buy. So these are the two options we are considering. Should I lease an asset or should I buy an asset? If you lease an asset, it means you don't own the asset. So there is no ownership here and no possibility of owning it in the future. No ownership. You get tax benefits on your renter. Likewise, usually the renter is paid in advance. All the leases I've ever seen, renter is paid in advance. So which means for a year, most time renter will be paid in January. And you know what that means when you are plotting cash flows? It means your cash flows must be plotted a year before. Because our cash flow that we use to discount in our NPV technique must happen at the year end. We are plotting it. right? So rental is paid usually in advance, right? Please take note, very, very important. And if you look at buying, you have ownership when you buy. So there's ownership. The tax benefit is based on the cost of the asset, which is capital allowance, which we have seen before. Right, there's no renter here, so here there's no renter because you are the owner of the asset. And if the asset has a residual value, you can't get residual value on a leased asset. But mind you still need to be careful with questions. Sometimes questions just want to paint something that is not practicable, but want to test your understanding. So if the question says for this operating lease or for this lease, the lessee will get the residual value, then you need to add it to your cash flow. But most times, the lessee does not get the residual value. It's the owner of the asset that get the residual value. So residual value is added here. Yeah. So those are quick basic differences you need to really know about these options that we are talking about. But the best way to appreciate it is to go straight into a question. Yeah. So you see how this is being done. Yeah. And let's quickly look at the question. Let me put up a question. Yeah. So let's look at this question. Yeah. Look at this question of Company D. Company D is considering how to finance its new project. And it has two options. Option 1 is either to lease the asset. Option 2 is to buy the asset. If it's leasing the asset, it's over 4 years. And rental is 30,000 per year. And this is payable in advance, which you normally get in any lease. When you pay your rent, there are no landlords that will allow you to pay your lease after the lease period. You usually pay it before. Yeah, option 2. But also know that the question can also be tricky and ask and let you know that the lease is paid in arrears just to test your understanding. In that case, you need to treat your cash flow accordingly. Yeah, don't say because lease should be paid in advance and the question is telling you this lease is paid in arrears and you're not treating it like that. That would be a wrong treatment. Yeah, so pay attention to the question. Option 2 is to buy the asset with loan from the bank. So he has the option of collecting a principal amount of 100,000 from the bank to buy the asset, and the bank will charge interest rate of 15% before tax. That's another thing you need to pay into account. So your interest rate must always be after tax. So let's quickly resolve that. Yeah, you can't use interest rate before tax for this calculation. So interest rate must be after tax. We've been given before tax of 15%. So before tax is 15%. So we need to calculate after tax. And after tax is just tax adjustment, which we normally do, which is equals to that 15% into bracket 1 minus T. And that equals to 15% into 1 minus the tax rate was given as 33%. So which means we have 1 minus 0.33 multiplied by 15. And that gives us 10%. So after tax rate, interest rate after tax is 10%. That's 10%. So we have that sorted. So residual value is 10,000 and capital allowance is 25% on reducing balance. The question is, which option should this company D go for? Should they go for option 1 or option 2? Now, this is why we now need to apply the concept of NPV that we know. So we're going to calculate NPV for the two options and we'll go for the better NPV. So we'll calculate option 1 NPV, we'll calculate option 2's NPV, then our decision will be the better NPV. We'll go for the better NPV. So let's do for option 1, which is the leasing option. Let's check the NPV. So option 1, we'll plot our cash flow. Remember, NPV is all about plotting cash flow. So plot option 1 cash flow. So we have year 1. We have year 2, year 3, year 4. It's good to also start from year 0. Remember, always, it's very important. Yeah, I need to, let me clean that up. So we have year. So we'll start from year 0, year 1, year 2, year 3, and year 4. Yeah. In this question, it was not specifically stated whether tax is paid in the current year or paid in arrears. So if it is paid in current year, it's simpler. If it's paid in arrears, it's more difficult. So I'd rather do something that is more difficult for you, so you learn how to do it. If you can learn the more difficult one, the less difficult one, definitely it's better for you and going to be easier. So in this question, I will also add that tax is paid in arrears. Yeah, so let me note it somewhere here. So I'll say tax is paid in arrears, because this is really important. Because sometimes when examiner want to stress you a bit, they give you that caveat, and in that case, the treatment is totally different. So when tax is paid in arrears, automatically you're going to have year 5. You're going to have one more year. So let's take note of that. Yeah. So we have our year. Then we need to plot a cash flow for each year. Yeah. So for year 0, we're going to plot what will be the cash flow for year 0. We'll know that in year 0, there's nothing happening in year 0 under the lease option. The first thing that will happen under the lease option is lease payment, which is going to happen in year 1, right? Because we're going to pay lease in year 1, year 2, year 3, year 4. That is what the question has said. 30,000 payable every year per year, right? So the only thing here is that these cash flows are paid in advance, which means they are paid just at the beginning of the year. So the year 1 cash flow is not paid in December, it's paid rather in January. Since it's paid in January, it means that is also happening at the end of year 0, which is the year before, right? Which is now, right? So, and in that case, the cash flows will be plotted accordingly. And that cash flows will be plotted here. So, which means our cash flow of 30,000 is happening first in year 0. Because remember, this cash flow we are plotting here in this column must be cash flow that happened at the end of the year. So, and likewise, the beginning of year 2 that is paid will be plotted at the end of year 1. And likewise, the 4 years. So, we have that cash flows plotted. Easy. So, we don't have any cash flow in year 4, because the cash flow that happened in year 4, which is going to be beginning of year 4, and that's what we have plotted at the end of year 3 here. Yeah. So those are the lease cash flows that we have, which is for the lease payment. There's another thing that is happening for lease. There's going to be tax benefit. Remember, there'll be tax benefit. Because remember I said that your lease gets tax benefit because it is allowable expenses. All lease payments, operating lease payments, are allowable for tax purpose. So, which means you're going to, for the year 1 tax, for the year 1 lease that you paid, you're going to get tax benefit in year 1. Yeah, that's why I picked these areas, because it's very, very confusing, and I want you to pay attention. Yeah, it's not as difficult as it looks, but pay attention. Remember, you paid tax in year 1, lease in year 1. Your first lease is in year 1, January, year 1. For cash flow purpose, we have posted it in year 0. But that doesn't change the fact that this tax is due in year 1. is tax for year 1. It's not tax for year 0. So this is for year 1 tax. But the taxman has said that this tax is payable in arrears. So it's only going to be payable in year 2. So the first tax is payable in year 2. So which means the tax benefit as well will be gotten in year 2. And the tax rate is 33%. So 33% of 30 is the tax benefit that we're going to get, which is 9.9. So the first tax benefit, we only get it in year 2, and like that for all the 4 tax benefits. That is how we're going to get it. I hope it's not confusing and you understand that. If not, please let me know. You can send me a message, or you can also put a comment. Yeah, if you want to. So your total cash flow. Yeah, so our total cash flow will be net of those 2. So year 0 remains 30. Even year 1 still 30. Year 2, if we add all of that together, we have 20.1. Still negative. 20.1 negative. We have then 9.9 and 9.9, both positive. So we need to get our discount factor at cost of capital, and we know that the after tax cost of capital is 10%. Yeah, you must use the same cost of capital for your discount rate for both lease or for buy. Cost of capital is cost of capital. Cost of capital is the interest rate at which a company will borrow money, and we already have that information available. That if it's going to borrow money to buy the asset, it's going to be at after tax cost of capital of 10%. So for year 0, discount factor is always 1. Always 1. So 1. Then we're going to have 0.909, 0.826, 0.751, 0.683, 0.621. Yeah, then we have our present value, PV. First year is minus 30, minus 27.3. If we multiply 20.1 by 0.826, we have 16.1.6. This one, we have minus 15.1. Then we have 6.76 positive. Then 9.9 times 0.621 gives 6.2. Then if you add everything together, we have NPV of negative 76. So that is NPV for option 1. Let's look at option 2. Option 2 is buy. Buy. Should we buy? Let's find out if we should buy. So the same way we plotted our cash flows, we have to plot cash flows for option 2. This is probably quite straightforward because all you have is the capex and tax benefit. All right, so I'm going to have here 0, 1, 2, 3, 4, 5 because we have tax being paid in areas, so there will be additional year. Yeah, so we have cash flows. So we can do all this cash flow together here. In year 0, we're going to buy the asset for minus 100. But year 1, 2, 3, 4 is just only tax relief that we'll get, our tax benefit, which is the capital allowance. So let's do a working one here. So capital allowance cost. You have cost. You have depreciation. You have net book value. And you have the tax benefit. So at 25, depreciation is at 25%, reducing balance. So which means year 1, we're going to have 25. Let's get to 75. So year 1, year 2, year 3, and we'll stop at year 4. Yeah, so this becomes 75, then 0.25 times 75, that's 18.8. 18.8, that gives 56.2. Now 56.2. Then I multiply by 0.25, so we have 14. Then that gives us another 42.2. 42.2, not 42.4. Then end year 3 of 42.2, start year 4 at 42.2. Multiply by 25% reducing balance, and that gives us 10.5. And with 42.2, we close with 31.7. Close with 31.7. So tax benefit will be at 33% of the depreciation. Yeah, so if we multiply 25, multiply by 0.33, so we'll get the first tax benefit at 8.3, 18.8 at 33%, 6.2, 14 at 33%, 4.7, and the last one is 10.5 at 33%, and that gives 10.5. 10.5 times 33%. So we have 3.5. However, like I always say, when you're doing your capital allowance tax benefit, there's always part 2 of it, which is the last year. So last year, you're going to talking about your selling price and your net book value to get profit or loss. Net book value, we have it as closing at 31.7. Selling price is a residual value. Our residual value has been given at 10. So if you sell an asset that is worth 31.7 at 10, you're going to be selling at a loss. So you will make a loss of 21.7. And in that case, you are entitled to a balancing allowance at your tax rate of 33%. So which means, remember, if this had been a profit, you would have paid same tax at 33%, but because you lost, you will get tax benefit at 33%, and that's additional 7.2 tax benefit for you. So which means the tax benefit for last year is 3.5 plus 7.2, and that gives you a total of I think that's 10.7. I'm seeing. Take 3.5 plus, sorry, not times, plus 7.2. That's 10.7. So means our tax benefit for that year is 10.7. which is very good. Yeah. So if you look at it, now we have a tax benefit all spelled out. Year 1, we have 8.3. Year 2, we have 6.2. Year 3, we have 4.7. Remember, our tax benefit is the tax rate of 33% multiplied by the depreciation. So this is depreciation column, and this is the rate we have been using. Yeah. And with that, you're able to decide on what exactly will you get as tax benefit, which is cash flows you need in order to determine the net present value of the asset. So the warning I want to make again is this part too, because sometimes students get confused with the last year. See what we've done. We've deducted the cost from the depreciation for the year. We've got this. So the first part of depreciation is this, which is 3.5 depreciation for the year. But however, because there is always net book value left, which is 31.7, and we're only selling the asset for 10, which means we are left with a net book value of 31.7, and we're going to sell the asset for 10. So if you deduct that 10 minus the value of the asset, you are left with this 21.7, and that gives you additional benefit. At 33%, you have additional 7.2 tax benefit, and that's how we got the 10.7 as your tax benefit. So let's plot those tax benefit quickly. But remember, because the tax benefit are coming also in arrears, so they will jump about one more step. So the first year tax benefit will come in year 2. So 8.3, 6.2, 4.7, and 10.7. Then discount factor will also be at the 10%, which is our after-tax discount rate. And year 0 will always be 1. There's nothing happening in year 1. We don't have cash flow interesting. So we'll put our discount rate there. So 0.909, 0.826, 0.751, 0.683, and 0.621. Then we get our present value. This remains minus 100. This remains 0. 8.3 times 8.26, that's 6.9. Confirm that. Yes, 6.9. Then 6.2 times 0.751. That's 4.66. Or let's just say 4.7. Then 4.7 multiplied by 0.683 equals to 3. So in year 4, there's something I missed out in year 4. There's a residual value. Yes, in year 4. Residual value of 10. They told us in this question. So if you are buying the asset, you'll be entitled to the residual value. Yes. And you can see it in the question on the left side. Residual value of the asset is $10,000. The second to the last line. So in year 4, we have an additional cash flow there. So instead of 4.7, I will add it together there, and I'll make it 14.7 because there's a $10 that coming, so 14.7. So this includes the residual value and tax benefit for year 4. Please take note. So that's why this is 14.7. So which means I should be multiplying 14.7 by 0.683, and that should be 10.04. That's how you as 10. Then the last one, 10.7 times 0.621, and that's 6.6. We had everything together to get an NPV. That's 6.6 plus 10 plus 4.7 plus 6.9 minus 100. And that gives negative 71.8. So we have NPV of this option A. Sorry, option 2, right? Option 2. And this is option 1. So we have negative minus 76 and minus 71. So option 2 gives a cheaper option. It's cheaper. because it has a better NPV. Yeah. So this company will be advised to go for option 2. And that is how your lease or buy question can be tested. It's not very common, but I just feel it's something I need to cover, so we know that we have fully dealt with investment decision and financing decision. So what we've done now is that we have covered the 3 major or most important parts of financial management paper. We've covered the working capital section C, we've covered investment appraisal section D, and we've covered financing decision section E. I know we've as well covered A and B of the syllabus, so we've done with 5 sections of the syllabus. Now we'll move to F, G, and H, which are quick part of the syllabus. This is extremely important, and I think I will start with this in my next video, so that we'll know that we only have the few parts F and G left. Valuation and I think ratios. We'll deal with that. But in the meantime, please keep liking the video, ask questions, share, and we'll connect again in the next video. Thank you.